History doesn't repeat, but it does rhyme. In 1637, it was tulips. In 1720, the South Sea Company. In 2000, anything with a .com in the name. For centuries, we thought market crashes were black swans, unpredictable, chaotic events. But what if the next crash isn't a surprise? What if it's a pattern our AI has finally learned to see? Today, we're looking at the cognitive leap. How AI is moving past spreadsheets to decode the DNA of human greed and fear. Every financial mania feels unique in the moment, a revolutionary break from the past. We convince ourselves that this time, the old rules of valuation and gravity no longer apply. But when you strip away the specifics, whether it's .com stocks in 1999 or the AI infrastructure gold rush of today, the underlying human psychology is remarkably consistent. The patterns are timeless. To truly understand the future and navigate the turbulent waters of market cycles, we must first dissect the anatomy of these manias. It all begins with a deceptively simple yet powerful idea. We have to look at the greater fool theory. At its core, it's the simple belief that you can knowingly buy an overvalued asset because you're confident there will always be a greater fool willing to buy it from you at an even higher price. It's a game of hot potato, played with billions of dollars. The last person holding the asset when the music stops is the one who gets burned. This theory explains the mechanics of momentum, but it doesn't capture what convinces so many people to start playing this dangerous game in the first place. Because bubbles aren't just about inflated prices or speculative greed, they are fueled and sustained by something far more infectious: narrative viruses. These are compelling stories that spread through society, reframing speculation as visionary investment. In 2026, we see this phenomenon unfolding in the staggering $500 billion big tech capex boom. The narrative is one of a productivity miracle, of building the very foundation of our artificially intelligent future. But is it truly a new paradigm? Or is it just the modern echo of the railroad mania from the 1840s, when investors poured fortunes into building tracks to towns that would never exist, all based on a story of manifest destiny and endless growth? The signals that a narrative virus has taken hold are always the same, repeating with uncanny regularity throughout history. You see a sudden explosion of media coverage, with magazine covers heralding a new era. Then come the celebrity endorsements, lending their credibility and glamour to complex financial assets. The very language of the market begins to change. The conversation shifts away from boring metrics like profit and cash flow, and toward intoxicating concepts like disruption, paradigm shift, and possibility. This narrative shift is a critical warning sign. It's the moment when the anchor to reality is cut. And finally, you see a sudden dramatic surge in public participation as everyday people rush in, terrified of being left behind. Humans, it turns out, are fundamentally hardwired for FOMO, the fear of missing out. This emotional contagion is what makes us vulnerable. Our instincts for social proof and our desire for quick wealth override our rational judgment. We see the crowd running, and we feel an almost primal urge to run with them, often without asking where they're going. But what if we could build an intelligence that was immune to this? An intelligence without fear, greed, or the desperate need to follow the herd. That's the promise of AI. While we are wired for narrative and emotion, AI is hardwired for the cold, hard math behind the hype. It can dispassionately analyze the numbers, track the narrative drift, and see the growing chasm between the story being told and the economic reality on the ground. It can be the rational mind in the midst of madness. Traditional analysis looks at what people are buying. 2026 AI looks at how they are feeling. We've moved beyond simple positive versus negative sentiment. Using natural language processing, or NLP, AI now quantifies the unquantifiable. It's tracking over a dozen emotional tones, from loss aversion to social proof. It monitors unstructured data. It listens to the subtext of earnings calls and the vibe of investor forums. When the AI detects a narrative drift, where the reason for buying becomes disconnected from the actual revenue, the alarm bells start ringing. To navigate the sheer complexity of this new landscape, we need more than just spreadsheets and trend lines. We need a crystal ball. And in 2026, we're building the closest thing to it. This is where the analysis moves from the observable world into the realm of simulation, where it gets truly sci-fi. We're talking about creating digital twins of the entire market ecosystem. Think of it as a complete living mirror of the financial world, running in a sandbox environment. It's a virtual replica, not just of stocks and bonds, but of the very infrastructure we've been discussing. The data centers, the power grids, the supply chains, and most importantly, the human and algorithmic behaviors that drive it all. We populate this simulation with millions of autonomous AI agents, each one a ghost in the machine representing a market participant. These aren't simple bots. They are sophisticated models trained on vast datasets of real-world behavior. Some are programmed to be hyper-aggressive momentum chasers, buying into strength and selling into weakness. Others are modeled on cautious, value-oriented institutions that buy on dips. We have agents that mimic high-frequency traders, reacting in microseconds, and others that represent slow-moving pension funds. We can dial up their greed, their fear, their reaction speed, creating a digital petri dish of market psychology. With this digital world at our fingertips, we can finally ask the most powerful question in finance: what if? We move beyond forecasting and into the realm of systemic stress testing. What happens if a geopolitical event disrupts the supply of a critical semiconductor component? We don't just guess. We initiate the event in the simulation and watch the dominoes fall. We can model an unexpected interest rate hike from a central bank, or a major energy bottleneck hitting the AI data centers in a specific region. We watch the contagion spread through the network in real time, identifying hidden correlations and vulnerabilities that would be invisible in traditional analysis. It's about finding the financial fault lines before the earthquake hits. But this incredible power introduces a profound, almost philosophical paradox: the observer effect. In physics, the act of observing a particle changes its state. In these new markets, the act of predicting an outcome can't. Imagine a widely followed AI model predicts a 10% market crash based on its simulation. If enough traders trust that AI and preemptively sell to avoid the predicted loss, their collective action the very crash the AI foresaw. The prediction becomes a self-fulfilling prophecy. We call this feedback loop recursive volatility, and it represents the new, unpredictable frontier of systemic financial risk in the age of artificial intelligence. So, we've journeyed through the anatomy of market manias, from the tulip fields of the 17th century to the silicon gold rush of today. We've seen how narratives take hold, how the promise of tomorrow can obscure the realities of today. We've dissected the sentiment stack, modeled the madness, and identified the new, complex risks that come with an AI-driven world. But knowledge is only potential power. The real question is, what do you do with it? How do you navigate this landscape of unprecedented opportunity and equally unprecedented hype? This brings us to the playbook. It's not a crystal ball, but a framework for prudent decision-making. It's your checklist for sanity when the market loses its mind. First, and most critically, always measure the gap between sentiment and tangible ROI. When the story is soaring, but the profits are not, that's your signal to pause. Is the excitement funded by solid revenue or by the hope of a future buyer? This is the core of our analysis. Second, scrutinize the financing mix. Is the growth fueled by sustainable cash flow and smart debt, or is it propped up by venture capital and the promise of another bigger funding round? The source of the money tells you a lot about the stability of the enterprise. Third, assess the hard infrastructure constraints, especially energy. In a world building massive data centers, access to power isn't just an operational detail. It's a fundamental barrier to entry and a major risk factor. A great AI model is useless without the watts to run it. Fourth, look for vendor lock-in. Is a company truly innovating, or is it just deeply integrated into a single ecosystem? True long-term value comes from portability and resilience, not dependence. Finally, drill down to the unit economics. Forget the grand vision for a moment. What does it cost to acquire one customer? What is the lifetime value of that customer? Is there a clear, profitable, and scalable path for each unit of the business? If the math doesn't work at a small scale, it's unlikely to work at a massive one. This is the intersection we've talked about, the place where the hype meets the hard hat work. The edge in the coming years won't belong to the company with the most data or the flashiest demo. It will belong to the one that masters the unglamorous, essential work of building a real, sustainable business. So, can AI truly see the future? No. But it can illuminate the patterns of the past as they replay in the present. It provides a sophisticated weather report for the economic storms ahead, but you are still the captain who must navigate the vessel. It gives us the tools to ask sharper questions and demand better answers. When you see sentiment decoupling from reality, when the story is all about a distant future with no regard for the present, it's time to be cautious. In the classic game of the greater fool, where assets are bought with the hope of selling to someone even more optimistic, the only winning move is to refuse to play. The goal is not to be the last one holding the ticket when the music stops. This framework isn't about predicting a crash. It's about building resilience. It's about choosing to invest in value, not just narratives. It's about understanding the difference between a technological revolution and an investment bubble. They often happen at the same time, but they are not the same thing. The key is to embrace the former without being consumed by the latter. Which brings us to the ultimate question. Are we in a bubble right now,